So it might look weird, but that's the whole reason, because it resets that 7-year term. In terms of medium-term solutions, so these are better. Here we go. Now, a very common one we do is just pay the minimum repayments on the unsecured loan. So again, if we think back, unsecured Division 7A loan is a 7-year term. There's minimum repayments. We can pay these in cash, so actually transfer back, or the alternative in terms of paying them back is to issue dividends to the shareholders or pay salaries to the people running the business on paper only. Instead of paying them cash, it reduces the loan outstanding. So basically, let's say there's a $10,000 minimum repayment needed. We can issue a $10,000 salary, and instead of transferring cash from the company to the personal account, we can just reduce that off the loan that person owes back to the company. So that's one of the medium-term solutions. The next one is cascading loans. So if you're taking more cash out each year, we can start a new loan in that financial year that you take more cash out of the company. So the whole idea of why we would do that is basically it resets your 7-year repayment term. So some of you on your balance sheets may have, loan dash your name 2020. On the next line, loan dash your name 2021. So again, each financial year may have its own cascading, or each loan may have its own financial year attached if you are drawing down more each year. So it might look weird, but that's the whole reason, because it resets that 7-year term. Build up the loan, knowing you'll pay the dividends to repay minimum repayment or the full loan. So what I mean here is sometimes this is a strategy we use when people are retiring, and we know that, or they're coming up to a business exit. So we'll intentionally tax them less in their own names, build up a bit of a Division 7A loan in their company. And then once they're no longer earning income in the company, we can pay down dividends back to the individuals to reduce that loan outstanding. So, or another way we do it is just leave the money in the company and issue the dividends each year to extract that money once the business is sold or they've become retired. So again, we've got a handful of clients who we've helped through that process with, and some that have sold a business 3, 4, 5 years ago, but each year they get a dividend back and they get a refund of those franking credits we talked about before. So again, that's another one that may help. And again, that's a very specific set of circumstances for a client.